Welcome to the second tutorial on joint venture account. In the first tutorial, we have learned about the theoretical issues on joint venture accounts. In this tutorial, we are going to learn about the accounting entries or journal entries, as well as the process of preparing accounts or ledger from this tutorial. From the previous tutorial, we have learned that when the separate set of books are kept for maintaining accounts in joint venture, we have to prepare three types of ledger or accounts. You can see the first one is joint bank account, and the second one is co-venturers accounts, and the third one is joint venture account. Actually, this is the account or ledger from where you will get idea about the profit and loss from this joint venture. And since we are going to learn about the journal entries, we will get a clear idea from this writing about the necessary journal that in the joint venture account, which can be considered as the profit and loss account, we show the goods purchased, goods supplied by the co-venturers, and all other expenses in the debit side. That means in the debit side of the joint venture account, we show all the goods purchased or goods supplied by the co-venturers and all other expenses in the debit side. On the other hand, the credit side of the joint venture account shows the sale proceeds or sales revenue and unsold stock. And if the credit side is higher, then the balancing figure would be considered as profit. But if the debit side is higher, then the balancing figure would be considered as loss. I would like to repeat that all the goods purchased, goods supplied by the co-venturers, and all other expenses should be shown in the debit side of joint venture account, and sale proceeds and unsold stock should be shown in the credit side of the joint venture account. Now we are going to learn about the journal entries, which is the main discussion topic of this today's tutorial. We can see whenever the venturers contribute cash, then the journal is joint bank account. Due to contribution with the cash, the bank account will be increased. That's why it's an asset. Asset would be debit. And the contribution is paid by the venturers. That's why co-venturers accounts credit. Whenever there is a purchase of goods using the bank account, then joint venture account. We have shown that purchase, goods supplied by the co-venturers, and all other expense should be shown in the joint venture account in the debit side. That's why whenever there is a goods purchased, it should be shown as joint venture account debit. All purchase, goods supplied by the venturers, all other expense should be recorded as joint venture account debit. However, we can see goods purchased out of joint bank account, that should be recorded as joint venture account debit, and since you have paid through the bank, that's why bank account credit. But if you purchase the goods on credit, not cash, then same journal, joint venture account, but since you have not paid, that's why it's a liability. Creditors, generally nowadays the creditors are considered as accounts payable. That means whenever you purchase the goods on credit, then venture account debit, creditors or accounts payable credit. Whenever any co-venturer supplied the goods, then same joint venture account debit, and since it is supplied by the co-venturers, that's why co-venturers account credit. And whenever you pay any expense, we have learned that all other expense should be shown in the debit side, that's why joint venture account debit. So for expense, joint venture account debit, since you are paying the expense from bank, that's why bank account credit. Again, if the expense is paid by any co-venturers, then co-venturers account credit. So whenever there is a sale of goods in cash, then due to increasing amount in cash, the bank account debit, and we have learned that all the sales proceed and unsold stock should be shown in the credit side of joint venture account. That means joint venture account would be credit for sale proceeds and unsold stock. So we can see goods sold in cash, bank account debit, joint venture account credit. For sale and unsold stock, the joint venture account would be in the credit side. But if any co-venturer keep the sale proceeds, then co-venturer accounts debit and joint venture account credit. For sale proceed, we are showing the joint venture account credit, but if the cash is received, then bank account debit. If the sale proceeds are kept by any co-venturers, then co-venturers account debit. But if you sell the products or goods on credit, then debtors account, accounts receivable account debit. If any co-venturer take the goods, then co-venturers account debit, joint venture account credit. And whenever there is a collection from the debtors from the account receivable, we can see due to collection, bank account will be increased, that's why bank account debit. And whenever we sell the product on credit, accounts receivable debit or debtors account debit. Here after collection, accounts receivable or debtors account would be credit. So after collecting the cash from the debtors or accounts receivable, bank account debit, debtors account or accounts receivable account credit. But if there is a bad debt, that means if there is any uncollectible amount, in that case account receivable will be decreased and it's one kind of loss. And we have learned that all kinds of loss or expenses should be shown in the debit side of joint venture account, that's why joint venture account debit. And whenever you are paying the creditors account debit or accounts payable account debit, and you are paying from the bank, that's why bank account credit. And if there is any venturer who is managing the venture operation, then he is entitled to get commission. Whenever you need to pay the commission, then the joint venture account debit. We have learned that all kinds of expense should be debited in the joint venture account, that's why joint venture account debit. And since this commission should be paid to the managing venturer, that's why co-venturer account credit. This co-venturers indicates the managing venturer. And I have already told you that after preparing the joint venture account, this is the sample of joint venture account. We have learned that in the debit side we have to show all the expenses, all the purchases and all the goods supplied by the co-venturers. On the credit side we have to show all the sales proceed or sales revenues and unsold stock. And in this joint venture account, whenever the credit side is higher, then the balancing figure would be shown as profit. Here we can see this is the higher amount, that's why the balancing figure should be shown as profit. Here the amount of profit is 1800 plus 2700. But if the debit side is higher, then there will be a loss from the joint venture account. However, whenever the credit side is higher, then it is considered as profit, and for profit you should show as joint venture account debit, co-ventures account credit, because ultimately this amount would be shared with the co-venturers, and whenever we are sharing the profit, the sharing ratio should be used. But if there is a loss, if the debit side is higher, then the journal is co-ventures account debit, joint venture account credit. After doing the journals and ledger, the joint bank account and co-venturers accounts will show the same balance. The sum total of co-venturer accounts must be equal to the joint bank account. However, for the final settlement, if the co-venturer account shows debit balance, then he should bring money, and the journal would be bank account debit, co-ventures account credit. But if there is a credit balance in the co-venturers account, then he should be paid. Then the journal would be co-ventures account debit, joint bank account credit. So these are the initial discussion for the journal entries. To know the practical process for the journal entries in the book of joint venture, we are going to show an illustration. Here we can see an illustration or example or a problem from where we should prepare the journal entries, or we should record the journal entries. We can see Mono and Anusha entered into a joint venture and agreed to share profits and losses in the ratio of 2:3. They opened a joint bank account in which Mono and Anusha contributed Taka 8,000 and Taka 10,000 respectively. They purchased 10 condemned television sets at the rate of Taka 1,500 each. That means at the rate of Taka 1,500 they have purchased 10 television. They made the reconditioning cost Taka 3,000 from the joint bank account carriage, and other expenses of Taka 2,000 were borne by Anusha. That means the total cost of television sets are 15,000, because each set is costing Taka 1,500. For 10 television set, the total cost would be 15,000. This is the purchase cost. Along with this purchase cost, there are additional cost which is 3,000 for reconditioning and 2,000 for other expense. Ultimately total cost is 15,000, 3,000 and 2,000. Total 20,000. Another information is Anusha received a check of Taka 1,000 from Mono, and we have learned that there were 10 television sets, out of which 9 sets were sold at the rate of Taka 2,500 each, and the rest one was taken by Anusha at cost. Now we have to prepare the journal entries as well as the ledger accounts for joint venture account, joint bank account, and we should close the accounts of the venture. From this illustration or example, now we will show the journal entries. So this is the journal book for the joint venture. We can see whenever the joint venturers, I mean Mono and Anusha, contributed Taka 8,000 and 10,000, the journal is bank account debit, because due to contribution the bank account will be increased. That's why bank account debit. We have shown the amount in the debit side 18,000, and the amount of 18,000 is coming from the 8,000 plus 10,000. 8,000 is contributed by Mono and 10,000 is contributed by Anusha. And the second one is they have purchased 10 television set at the rate of Taka 1,500. The total would be 15,000, because each set is of taka 1500. That means the total amount would be 15,000 for 10 sets. We can see the 15,000, and from the initial discussion we have learned that goods purchased or goods supplied by the co-venturers and all other expense should be shown in the debit side. I mean, whenever there is a purchase, whenever there is a supply of goods from the co-venturers, and whenever there are expenses, the joint venture account would be debit. That's why due to purchase, the joint venture account is shown in the debit side with the amount of taka 15,000, and since the amount is going to be paid from the bank account, that's why bank account will be decreased. That means joint bank account credit 15,000. Each television set is taka 1,500 and 10 sets total 15,000. Along with this 15,000, there is a cost of 3,000 for reconditioning. From this initial discussion we have learned that all the expenses should be shown in the debit side of joint venture account. I mean, for expense, joint venture account should be shown as debit. That's why for this 3,000 reconditioning expense, the journal is joint venture account debit 3,000, and since this amount is going to be paid from the bank, that's why bank account credit 3,000. And there is another expense that is paid by the Anusha. So whenever there is an expense, joint venture account debit, we can see joint venture account debit 2,000, and this amount is paid by Anusha. That's why Anusha credit. Then we can see there is a information that Anusha received a check from Mono of taka 1,000. Since Anusha has received, Anusha account debit, and the amount is from Mono, that's why Mono account credit. Then we can see there is a information of sale. We have seen that they have purchased 10 television, but they have sold 9 sets of television at the rate of taka 2,500. For this sale, the journal is joint bank account because the sale is done in cash. So due to cash sale, the bank account would be increased. That's why joint bank account debit 22,500. There was a sale of 9 television at the rate of taka 2,500. Total amount would be 22,500. Due to sale proceed, bank account would be increased, and from the initial discussion we have learned that sale proceed and unsold stock should be shown in the credit side of joint venture account. That means joint venture account should be credit for sale and unsold stock. So for this sale, the journal is bank account debit and joint venture account credit 22,500. And there is information that out of 10 television set, 9 televisions were sold, but there is another one that is taken by Anusha at cost. Since unsold stock is taken by Anusha, and from the initial discussion we have learned that whenever there is an unsold stock, we have to show the joint venture account in the credit. The unsold television is taken by Anusha. The journal is Anusha debit 2,000 and joint venture account credit 2,000. So how have you calculated this 2,000? We have learned that they have purchased the television by paying 15,000. There were additional cost of 3,000. You can see this is the 3,000 for reconditioning expense. There was a 2,000 cost that was paid by the Anusha. Total cost is 20,000. How? 15,000 plus 3,000 plus 2,000. So the total cost for the television 20,000, and if you divide this 20,000 by 10 television set, per television cost is 2,000. Anusha has taken the unsold stock at cost price, and the cost price is 2,000 for each television set. Since Anusha has taken one television set, the cost price is 2,000. That's why Anusha debit 2,000 and joint venture account credit 2,000. And we have done most of the journal. Now from the journal entries that were made in the initial stage should be inputted in the ledger of joint venture account. After inputting the information, we can see that here joint bank account, this is the sale proceed and this is the unsold stock that were shown in the credit side, and in the debit side we have shown the purchase cost and the other expenses, and there is a difference. We can see the credit side is higher and debit side is lower. Whenever there is a higher credit side, then balancing figure should be shown as profit. Here the balancing figure is 4,500, and this 4,500 is distributed to mono with a taka of 1,200 as a ratio of 2:3. Since total profit is 4,500, this 4,500 should be distributed in the ratio of 2/3. The distribution amount is 1,800 for mono, and for Anusha 2,700, total 4,500. This is the profit. So due to profit, we have to distribute the profit to the mono account and Anusha account. We can see mono 1,800, Anusha 2,700, total 4,500. So whenever there is a profit, we show it in the debit side of joint venture account. That's why joint venture account debit. And we can see what is the process of calculating this profit. We can see sale proceed is 22,500 and unsold stock value is 2,000. There is one kind of sale to Anusha, although it's unsold stock, but this 2,000 is taken by Anusha. It should be considered as sale proceed. Total sale proceed is 24,500 and total cost is 20,000. So after deducting this 20,000 from 24,500, the profit is 4,500, and this profit should be distributed in the ratio of 2:3. The final settlement should be provided to the co-venturers. The total amount is 22,500. We can see 22,500. That is the sale proceed, and if you distribute the sale proceed, then the amount for mono is 10,800. Amount for Anusha is 11,700. So this journal is for the final settlement. So these are the journal entries that were made from the illustration or example. From these journal entries, we can prepare the ledger. We can see the first ledger or first account is joint venture account. Whenever there is a mention of joint venture account, we can see here joint venture account debit. So this 15,000 should be shown in the debit side. Then the opposite name is joint bank account. So here joint bank account, this is shown for the purchase. Then we can see there is another joint venture account debit. So this debit amount 3,000 is shown here, and the title should be opposite joint bank account. So joint bank account, this is the cost for reconditioning. However, in this way you can prepare the ledger, and already we have learned that in short way we can prepare the joint venture account by showing all the sale proceeds and unsold stock in the credit side, and all the purchase and goods supplied by the co-venturers and expenses should be shown in the debit side. And after calculating the balancing figure, we can get the profit, and profit should be distributed based on the ratio, that is 2:3. So this is the process of preparing ledger. We can see here this is the ledger of joint bank account. We can see here joint bank account debit. So 18,000 should be shown in the debit side. So total 18,000. Out of this 18,000, 8,000 from mono and 10,000 from Anusha. So this is the process of preparing ledger. You can write the other figures in the same way. Whenever you are preparing one account, if it is in the debit side, then write the amount in the debit side, then in the accounts title show the opposite title. The same way you can prepare all other ledger accounts for the joint ventures. So these are the today's discussion on journal entries and ledger accounts for the joint venture. Thank you.